today discuss whole life insurance and index universal life insurance and which one is better for retirement. What is better, whole life insurance or index universal life insurance? I don't know. It really depends on you. But if you're watching this video, you probably have already dispelled, or maybe you're looking for some cons and some bad things to say about both whole life and IULs. Well, I'll tell you them all right now. IULs and whole life insurance, they're very complicated products which require lots of fees. Also, if you don't listen to the rules and guidelines of the policy and you surrender or you take it out early, there's lots of penalties. Also, it's one of those kind of elastic tools where if you don't continually pay the premium, the thing lapses, you lost all the money you put in. It sucks. It's also not gonna beat the stock market, unfortunately, because, well, the stock market has, only goes up, right? And also the stock market has a lot more risk involved, as whole life policies and IULs really don't have a way to lose money in the interest cash value type account. So those are all the bad things. Also, the most important thing is that bad people like me sell them to unassuming people like you, right? So that's hopefully not the case. And I do tons of videos to help educate both my clients and people who are interested in insurance and just in the entire industry as a whole. All right, so in today's video, what I really wanted to do is just pretty much take two sides. So we're gonna go with the whole life on this side and the index universal life on this side, and kind of like the middle ground of which one would work, the pros and cons. So on the whole life insurance side, whole life insurance is great because it provides you with a pretty much static type of life insurance. If you want to do a 7-pay whole life, you pay 7 years, and you got this policy that will last for the rest of your life. Thus the name whole life. Now, for retirement planning though, that's not really advantageous, as with retirement planning, we want to actually access this cash value. And many times these 7-pay or 10-pay or 15-pay or whatever pay whole life policies are really there to maximize the amount of death benefit we have. Now, I don't know how you want to spend your retirement, but I don't want to spend my retirement saving up money to pass on when I die. I need the money to fund my retirement, right? To do things, to buy things, to survive. So, is whole life insurance good for that? And on this side, to introduce you to index universal life insurance, index universal life insurance is kind of like whole life insurance in the fact where it's meant to be a permanent policy. It's meant to last your whole life. But it gives you the option to have a different non-structured way of paying the premiums for your life insurance. You can pay a little bit up front and a whole lot later on when the insurance gets more expensive. But that leaves us with kind of a uncomfortable situation where it might be cheap now, but it'll be really expensive when we get older. So when we actually want to take out money, the insurance will be really expensive. So how do we compete with that? How do we get around that? How do we structure these policies, both the index universal life and the whole life policy, to help us in retirement? Number one, for whole life policies, there's something called a paid up addition. What the paid up addition does is it kind of creates a separate standalone piece of a whole life policy that's already paid up. And what that does is the internal cash value, number one, gets interest on it, and number two, provides us with a dividend. And the dividend is pretty much what whole life is all about. Dividend paying whole life policies is what I'm talking about here. And that dividend goes back into the cash value and then compounds and grows. Now on the IUL side, how do we use the IUL, or the index universal life insurance, to generate wealth or to build a cash value? And the way you would do that is by choosing an index, thus indexed universal life. It's not about the indices of life insurance, it's about a specific index which is tracked usually on the stock market, or if you're some of these more sophisticated companies, they will have generated their own kind of indice that usually is tracked on Bloomberg or internally on their website. And what the index universal life cash value does is it creates an account that tracks this index. You get an interest credit either monthly annually or sometimes every 2 years on the index movement. Now, with this type of policy, typically these will have a participation rate, sometimes a cap, and also they will have a floor, meaning that you can't get below a certain percentage of interest credit. Some of these creditings are between 1% and 10%. Some have a zero floor and maybe a 15% upside. So it does depend on the actual policy. And the way that this policy kind of beats up at the end, when your life insurance is really expensive, is you go through what's called the life insurance corridor. That's kind of where the cash value and the death benefit are so close that they're almost equal. And then you're not really buying any insurance because the cash value is already supporting most of that insurance cost. So that's how the Index Universal Life Insurance portion kind of gets its, merits as a wealth building cash value accumulation tool. So with that said, which one of these guys is better? Well, that's going to depend on you. We'll go through the whole life side first. So with a whole life insurance policy, the kind of name of the game is conservative. Whole life insurance policies can return average anywhere between 4 and 6%, I would say. Now, it's not always going to be 4, it's not always going to be 6, it's going to fluctuate in between there, but that's kind of the assumed interest rate that you get. And every year, companies pay out a dividend. You are going to get that dividend, either you can get it paid to you in the form of cash or a check, direct deposit, or you can have it feed back into the policy. And that's what most people do who are looking to use the policy to generate wealth for retirement. Now, people who are going to want to purchase this type of policy are going to be more conservative, looking for that lower but consistent gains every year. It's not going to be like your stock market type gains where you're going to get 22%, 23% in a year, but you also won't see any years that are negative. You also won't see pretty much any years that are 0 or 1. It's going to be anywhere between 4 to 6%. At least that's what recent history has showed us, and the projections in the future. One thing to think about also right now is that bonds are paying more interest. We are raising the interest rates of the Fed funds, and thus all the longer term interest rates will follow. So whole life insurance may have a little bit more gains in the future as their interest rates do rise, and insurance typically does a little bit better in higher interest rate environments. So for people who are more conservative and don't want to see zeros, the whole life insurance is going to be the more, conservative route for those type of folks. What about IUL then? I don't want negative either. On the IUL side, most, if not all, Index Universal Life Insurance have a zero floor, which means that the money that goes into your cash value, the money that makes it into the cash value after the expenses of the policy are paid, that money goes into an interest crediting account. And that interest crediting account can get up to sometimes 11, 12%. And that's pretty good, right? 11, 12% is still not the 22, 23 that the S&P got last year, but it would have saved you from the nosedive that we've taken the first quarter of the year so far. So in that case, you would have gotten at least pretty much, hopefully, you would have gotten something credited, but if not, you wouldn't have lost anything either. So that's how an IUL works, and it's different. Now, many times, IULs have participation rates and cap rates. Participation rates means that from the point to point that you are putting your money in, let's say you put your money in on January 1st, 2022. We're going to take a picture of the SPY or S&P 500. Whatever that number is, that's going to be your starting point. Come one full calendar year later, January 1st, 2023, take that same picture. Now, if the index has risen 10% or more, we'll credit your account 10%. If it has gotten anywhere between 0 and 10, we'll give you whatever that is. Let's say it got 5%. What happens if the SP 500 went down? Nothing would happen. Your cash value would remain unchanged for that year. But that's if the participation rate is 100% and the cap rate was 10%. What happens if the participation rate is only 50%? Well, in that case, you'd only get up to, if the market went up 10%, you'd only get 5%. And if the market went up 5%, you'd only get 2.5%. But if the market went up 25%, then you would get 12.5%. So that's the major difference. And on top of that, you can choose typically between 1 to maybe 15 different indices that the company follows. And many of these indices are going to be kind of unheard of, and they're going to use terms like risk management or effective risk or effective rate, or sometimes it's modified risk. And these indices try and receive about 5 or 6% interest or gains for the year, and you might get a multiple. You might get 140% or 125% participation rate, which means that if the index grows by 10%, your interest credited would be at 140%, 14%. So there's a lot of different things that are actually in motion when you're looking at these IULs. So who's this product for then? Who should get this IUL then? I usually do it for people who are younger, who have maybe 15 to 25 years of time to absorb both the negative or absorb both the 0 years where you go through the flow where the market didn't return anything for you, and capture on those years that the market returns 10, 12, 14%. Right? They have more time, and also they have the wherewithal in the stomach to kind of, I guess you could call it, withstand that type of 0 years. So what should you do? Well, depending on your budget, normally people only use whole life insurance and index universal life insurance as a retirement strategy once they've exhausted their 401k employer match, their Roth, individual Roth IRA if they can contribute to that, and pretty much all the retirement, the standard retirement type of accounts. Now, if you are a high income earner and do not have access to individual retirement accounts and your 401k is already maxed, those folks also look to whole life insurance or an IUL to provide them with additional tax-free retirement vehicles. Now, again, it does depend on you. If you don't have more than, I'd say, $300 or $400 a month to put into a strategy like this, if you are in your 40s, then I would probably suggest looking at something else. Unless you really, really liked the safety of a whole life insurance policy and you also needed life insurance. If not, maybe that money could be used towards putting into like a brokerage account. Because for me personally, I don't think that's enough money to properly fund a whole life policy. $350 to $400 to $500 on the minimum. I'm used to seeing things like $20,000 to $30,000 a year being pushed into this thing to kind of help and accelerate the cash value accumulation in these things, which make it a really attractive kind of retirement vehicle because of the tax-free aspect of it and the guaranteed of no losing money, right? So, pros and cons, right? Well, I hope that kind of answered or kind of gave you just a little bit of insight on the differences between the two. I wanted to be a lot less technical in this video, but I do have many technical videos that you can watch if you want to. But if you want to do that, you'd have to kind of join my inner circle, because a lot of things that we talk about in this are going to be more conversations that I have with clients. And when I have these kinds of conversations with clients, it's going to require a little bit more focus on your behalf. And these videos are going to take me a lot more time to produce. So if you wanted to learn more about how to get into the inner circle, let me know by sending me an email down below, and I will let you know when those videos are released and when you can become a part of it. I'll see you guys in the next video.